What's up, traders? Welcome back to Golden Forex YouTube channel. Now, in this particular video, we're going to be talking about the average weekly range and how to use the average weekly range to determine your premium and discount for the upcoming trading week. Now, to use this concept, first of all, we need to determine what the average weekly range for this particular pair is. And for this example, we will be using the NAS 100 chart for this example. Now, first, we determine what the average weekly range or the average weekly pip movement for this current pair is. So we insert this indicator called the AWR. And when you plot it on the weekly chart, it gives you the average weekly pip movement for the NAS 100 pair. Now, if you look here, it says 572.9836, which means 572 pips for this pair for the average movement every week. So we're going to round it to 600 pips every week. And we're going to use that information to determine our premium and discount for the upcoming trading week. But before we go there, first of all, we need to know what direction the market will be going for the upcoming trading week so that we will know where we're going to be buying and where we're going to be selling. So if our bias for the upcoming trading week is bearish, then we can determine our premium using the average weekly range to sell. And vice versa, when we're bullish, we can use the average weekly range to determine our discount, what we're going to buy at. So with that, let's go to the 4-hour chart where we're going to use the average weekly range. So for this particular video, we're going to use the past 3 weeks for this example. And we're just going to use the current, and then we'll go back 2 weeks added to it. So we're going to use 3 weeks as an example for this particular concept. So we're going to use the weekly dividers, and then for each dotted vertical line is a week. So from here to here is 1 week, from here to here is another, and then from here to here is another. So let's just put a vertical line there denoting where we're starting. So we're going to be starting from here, and we're going to end on the 3rd week, which is the current trading week. Now, the average weekly range was 600 pips. So we are going to note that down somewhere. And the next step is we're going to note the closing price of the previous trading week. And we have 15003.03. So that is the closing price of the previous week. And we're going to divide the average weekly range in 2. So 600 divided by 2 will give us 300 pips. And we're going to project 300 pips from the closing price upward. And we're going to project 300 pips from the closing price downward. So we're going to use a rectangle for that. And at the closing price, we'll project 300 and 300 downward as well. So to make sure that you get the accurate prices, we're going to add 300 pips to the closing price, which was 15003. So when you add 300, you're going to have 15303.03. And then when you subtract, you're going to have 14703.03. So yeah, that is correct. So the average weekly range is 600 pips. And we want the closing price of the previous trading week to be at the center of the average weekly range. For step 2, we're going to divide this 600 pip range into 4 equal halves. So from the midpoint to the high is the upper portion, and from the midpoint to the low is the lower portion. So we're going to divide the upper portion in half, and we're going to divide the lower portion also in half. Now, when you do that, you're going to have 4 equally divided halves. So let's use a trend line to mark it. So we're going to have something like this. Don't worry, I will straighten it up and we're going to have the accurate prices. So this is what we're basically going to have. Now, for the next step, we're going to be required to have at least the bias for the upcoming trading week, whether we're bullish or bearish, just to determine the discount and the premium. So for this current trading week, we've seen what's happened. Since we already know what happened in this current trading week, we're going to assume that our bias was bullish. So when bullish, we want to buy at discount. And in this particular projected average weekly range, we have the closing price to the low of the average weekly range projected is our discount. So from the close downward to the low is our discount. Now inside of the discount region, we have the upper discount and the lower discount. So now we're going to use the actual prices to make it more accurate. And what we're basically doing is we're dividing the discount region into 2. So the discount region is 300 pips. And if we divide it, we're going to have 150 pips each of the discount region. So from the closing price, it was 15003.03. If we subtract 150 from it, we're going to have 14853.03. And that would be our upper discount. And this would be our lower discount. So when bullish, basically, I would expect at least the midpoint of the upper discount to be traded to. And on days where we have an elongated discount, I expect the midpoint of the lower discount to be traded to before turning. So basically the upper discount is where most of the time I'll be anticipating it a long. And anytime we fail to get to the premium and come back down inside of the upper discount, we can still participate in longs. So we've dealt with discount entries, and now we're going to deal with premium exits. So ideally, when you enter at a discount here, you are going to want to exit at the upper premium over here. But for deviations, we project 1/4 of the actual whole range above the upper premium for standard deviations. So we're just going to project 1 above it for standard deviations. And we're just going to change the color to something else. And yeah, we're done. So this is pretty much the projection for the average weekly range. Now we're going to do the same for the next 2 weeks. And we're going to familiarize ourselves with how to draw these projections. So for the next trading week, like we did for the previous trading week, we checked the average weekly range and it was rounded to 600 pips. So first things first, we're going to make sure that the closing price of the previous trading week is at the center of the weekly range projections. So the closing price of the previous trading week was at 14990.43. So we're going to add 300 pips to the 14990, which is the closing price of the previous trading week. And we're going to subtract 300 pips from the same closing price of the previous trading week. So when we subtract 300 from the previous trading week's closing price, we're going to end up with 14690.43. And when we add 300 pips to it, we're going to get 15290.43. And this will be the projected average weekly range. So the next step would be to divide the upper half and the lower half. So we're going to have 4 equal halves. So when you eyeball it, we can see that this is one midpoint and this is another midpoint. So in this instance, we can see that the market was a down movement for the current trading week. So in this instance, we're going to be looking to sell at a premium. So now we know from the closing price to the high of the projected average weekly range is the premium range, and the low downward to the low of the projected weekly range is the discount range. So we sell at premium and we buy at discount. So when bearish, we're looking to sell at premium. So if we're selling at premium, we have our upper premium right here at the closing price plus 150 pips. So let's just indicate the closing price right here. So we're using the closing price of the previous trading week, and we're just dividing the premium into 2. So when you add 150 pips to the closing price, which was 14990.43, you get 15140.43. So this is our upper premium region and our lower premium region. And just as stated in the previous projection, for deviations, we project 1/4 of the whole range down below if bearish. And then we just change the color to something else. So just as the previous projection, we said when bearish, we expect at least the midpoint of the lower premium to be traded to, and as far as the midpoint of the upper premium to be traded to, and a deviation of 1/4 of the whole range. So just as we did the previous, this will be our current projection using the average weekly range of 600 pips. And we're left with the current trading week. We're going to do the same projection for it. So first of all, we need to go over what we need. We need the average weekly range, which is 600 pips. And to project, we need the closing price of the previous trading week, which was this bearish candle right here. And the closing price was 14549.96. So we're going to project 300 pips plus the closing price and 300 pips minus the closing price of the previous trading week. So we bring our 600 pip projection, we line it up with the closing price, and then we use either our Fibonacci or a calculator to add these numbers. So the closing price was 14549.96. If we add 300 to it, we're going to be left with 14849.96. And then if we subtract, we're going to be left with 149,249.96. So this is what the projections would look like. And as I said, we need a bias to determine our upper discount, our lower discount, our upper premium, our lower premium. So as we can see, this was also a down moving week. So we needed to determine our upper and lower premium for our sell entries. So from the closing price to half of the premium region is our lower premium, and above that is our upper premium. So we need to properly adjust it. So 14849.96 plus 150 pips. So we're gonna have 14699.96, and that would be our lower premium. So as I said, we target at least the midpoint of the lower premium up to the midpoint of the upper premium, pairing it with PD arrays that you're going to be using for your forecasting. But for this specific video, we're only focusing on the average weekly range and how to project it to determine your premium and discount. And as always, for standard deviation, we project lower by 1/4 of the whole range. And then let's change the color to something else. And as you can see, it's pretty easy to project once you get familiar with it. So first of all, let's go over what we need to do before we start projecting the average weekly range for premium and discount. First of all, we need to go to the weekly chart, and then we determine what the average weekly range is by using the ATR indicator. After that, we divide the average weekly range into 2, and then whatever the half of the average weekly range is, we add it to the previous week's closing price, and then we subtract that half from the previous week's opening price. After we're done with that, the upper portion of the closing price of the previous trading week will be the premium, and the lower portion will be the discount. And depending on your bias, we will sell at premium and buy at discount. And afterwards, we just determine our lower and upper premium and discount. And then we put one standard deviation above when we're bullish and one standard deviation below when we're bearish. So that pretty much sums up the average weekly range projections. And we'll talk more about top-down analysis in subsequent videos. So that will be it for this video. Thank you for watching.